Welcome to ReLAWtionship, where real-life couple Justin and Candise share their keeping it real perspective on the ins and outs of their personal and professional experiences, navigating the ups and downs of partnerships in life and business. They will also offer practical advice for maintaining strong, healthy, fun, and successful relationships in life and business. If you're ready for comedic and insightful exploration of life, love, law, business, and everything else in between, you're in the right place. Buckle up, it's going to be a wild ride. Here are your hosts, Justin and Candise.
Well, welcome to ReLAWtionship. I'm Justin Cernitz, and I have my wife and partner here. You could say your name.
Candise Shanbron.
And we are law partners, and we're also married, which is sometimes a bit much. But we are here today, and we're here to record our podcast. And our guests on ReLAWtionship are Larry Kriesmer and Bernard Surovsky. They're the co-founders of Measured Risk Portfolios, a financial technology firm that specializes in creating custom investment solutions for institutional clients. We'll get into that, what that means soon. With decades of experience in the financial industry, Kriesmer and Surovsky are widely recognized as pioneers in the development of risk management tools and techniques. Today, Measured Risk Portfolios is known for its advanced risk analytics and investment models that help clients achieve their investment objectives while effectively managing risk. Welcome, guys. Welcome to the show.
Thank you very much. Thank you very much.
Now, before we begin and get really deep in our questioning, I need to first understand exactly, I understand in the most general sense, but if you can tell the audience exactly what it is that Measured Risk Portfolios does, that would be great.
Bernard, take it away. Nope, you go first and I'll clean up.
Oh, sure. Okay, I'll clean up. Thanks a lot, Larry. What we do is Larry and I have a long history in the financial services industry, and we lived through the the turn of the century debacle, 21, 22. And we both came to the realization that the traditional portfolio construction, it doesn't give clients any peace of mind in terms of what will happen. Our crystal ball fell off our tables for all of us collectively many times. So we decided to rethink the way a portfolio should be constructed. And what we did is we took ourselves off to London to go learn how to do a particular strategy that is actually very common in Europe. And we were then able to bring that strategy over to the United States and do it in an open platform, meaning it's in a way that you can see it, which is completely transparent. And when things are going rough, when the markets get rough, we build a portfolio with a finite, predetermined downside at the outset. So instead of taking your $1 million portfolio and putting it into this, that, and the other, which who knows how they're going to perform, we take your $1 million portfolio and we put the bulk of it into an asset class that we're very, very certain about its performance with respect to the positive returns. And then we take the other, a very small piece of it, and we put it into another investment that we know the worst it can do is lose 100% of its value. But if it goes well, it can make more than 200 or 300%. And when we pair those two things together, where you've got the bulk of your portfolio in something very, very safe and predictable, and you have a small amount of your portfolio in something that can have explosive growth or go away, we know at the very outset when we pair those things together just how bad it can be. In terms of the upside, that'll take care of itself. So when the upside arrives, it will perform because of the pieces that we've constructed together. And, having sat with clients, go ahead, Larry.
Yeah, and let me just say, what did Bernard say? Because the challenge in this type of arrangement is, wow, what did we just do? And I think that the recognition is that Bernard and I came to understand many, many years ago that the traditional market approach to diversification, putting small amounts of money into a lot of different things to try and avoid losing money, works when things are normal, and it doesn't work when things are not normal. And the problem is that when things are not normal is when you need it to work. So this is literally like trying to build, the perfect umbrella that you can't get out of the house because it's raining. And so fundamentally, we had to do something different. And that different was literally scrapping the idea behind investing directly in the market. And we chose to have to do something different in order to get a different result. And so to a product that is sold by insurance companies, marketed and does millions and probably, billions of dollars a year in sales. And we just deconstructed it and made it available in a brokerage account. So that's the sort of high level. what we're trying to do in this whole process is eliminate that uncertainty that happens when markets start to decline. Because when the markets are rising, nobody has any anxiety. Well, some people do. Some people are concerned it's going to stop because, eventually everything has to stop going up. But the reality is that
I said, I don't even like to sign into my account right now, because it's so
yeah, exactly. But imagine if you could have a conversation with your advisor or your team that's managing your portfolio and set a risk budget for the year that you have a high degree of confidence would be accurate. You don't have any idea what you're going to make on the upside, but going into like a 1 year period, what it is that you are risking. And if you have that kind of confidence, that's what we're really offering to institutions and just not necessarily just high net worth people, but just people. It's available, and it's something that can be constructed. All right. So the obvious question should be
a good point though, because that's a good lead into my question, because I was going to ask you, when I was reading a little bit about you guys, it seemed like you guys created this product for institutional clients. And so I was going to ask you, well, if somebody like me who has a diversified portfolio, who we just were talking about the fact that we don't want to log into our financial account because I can't bear to look at it, because whether it's 20 or 30% of it has just been gone. How do we have access to your product? Do you have a list of institutional clients that use your product? If we were, just average Joes that didn't want to go through the institution to do our investing, how would we get to your product? Because I'm interested. Sign me up. I mean, when I operate under the rule of thumb that I think most people that are realists operate, which is there are no certainties except death and taxes. When you say that, this has been the penultimate of all products that minimizes the most amount of risk in the investment arena, people like us that are, right now in shock and turning to real estate in a down market as a way to, put our money, where do we go to get your product?
So there's a distribution is available through, we have advisors that are located all throughout the country. And if you go to our website, which is measuredriskportfolios.com or mrpfolios.com, you can do a contact us and we can refer you out to an advisor. We generally don't work directly with the public. And that's because these types of contracts or these types of portfolios that we build at their primary level, they're very straightforward to understand. We take a very, very significant amount of capital and we buy the safest type of asset class we can. So most of your money is actually not in any significant harm's way. And then we take a adjustable amount or measured amount of your capital and we put it into an asset class that can actually lose 100% of its value. And you have to understand how that works and what the mechanics are. And so we really do rely on other external advisors to help you with that decision-making process. But this can be managed down to the $100,000 account level. So it's not like it takes $1 million or $500 million to access this type of strategy.
Okay, I know we're going to be contacting you after this podcast.
Yeah. Okay,
I think the short answer to your question is yes, we can. We built it to a point where it's, as Larry correctly points out, we can scale it down to very small numbers. It's available to individuals. It's not something which is only in the, it's not only available to institutional money. It's available to individuals. Are we allowed to say names of companies where we custody assets, or is that not allowed? I don't know. Is there any rule on that?
Let's just keep it generic. We can custody on a number of different platforms, and that's basically flexible for the investor. So that won't be an issue for us.
You said
I think.
I'm sorry. And you said
and I think
that every year you guys reassess with the client, or the institution would assess with the client to
that's why we work with intermediaries and other advisors, so that you can have somebody who is your advocate for making sure that the amount of risk that we're putting into the portfolio is still appropriate for you. We can't scale our operations if we have a personal relationship with every person, so that's why we rely on the advisors out there to have that personal relationship, to understand better your specific investment needs and your investment horizon, what type of risk tolerance you can manage. And then they'll help us pair you up with the right amount of risk for the portfolio strategy that we offer. And that's the relationship. We do this for some people through a sub-advisory relationship. We do it for other people through a solicitation arrangement. But in every case, there's some advisor between you or the public and us, so that we have some way of handling that type of specific recommendation. So that's the primary thing. But it really is, our whole goal was to bring some, I have to tell you, Bernard and I went through this 2002 tech bubble. It's a long time ago, 20 something years ago. And leading up to that, we had been building portfolios using exchange traded products, exchange traded funds, and trying to get into the sort of indexing or sort of a more passive approach with a, very diversified portfolio. And what we experienced was just back-to-back years of losing money with no kind of risk control other than diversification. And so when the markets start to decline and you're down 5% or 7% or 9%, we really, that's par for the course. But when the markets start to accelerate their sell-off and they get to 16% or 23% or whatever it is, every client is going to have their own number where their heart starts to palpitate and they can't really function very well. And if they reach, and believe me, so do advisors. I mean, this is the sort of not the dark secret, but it's the reality that if you're an advisor and you've got a flock of clients who you're in charge of taking care of, and they start to, panic, frankly, and they want out of what you've recommended that they be in, and they start getting under your skin about getting me out of this thing that's going down another 3% this week. And there's a terrible thing that happens to the advisor, and that is that they can start to lose confidence in their own recommendations. And if that happens, and the decision is made that you have to basically capitulate to the client's fears, then what inevitably happens is that client sells out at or near a bottom. And that is what is the big danger, because the risk is that person sells out and then is stuck with this terrible decision of making the unmakeable decision of when to get back into investing. Because inevitably, it's not when it's gone down another 5%. It's after it's recovered 5% or after it's recovered 10%. And so that loss is now baked in, gone, hard number, can't be recovered. And so that is the thing that Bernard and I were really trying to focus on. How are we going to help clients and, frankly, help our own practice survive? So when there is the inevitable big, bad bear market, that we're not going to be torn up by it, and that our clients wouldn't be torn up by it either. And that was the primary focus of trying to come up with something else besides just a mix of this new position. I mean, there are a whole host of assets that came out of the financial crisis and that came out of the tech bubble. We have managed futures and inverse products and products that go zig when the market goes zag. All of these things are designed to give us a bunch of tools that you can put through an optimization platform. And unfortunately, look backward and say, well, had I known what was coming, I could have built this portfolio, which would have performed beautifully. The problem is that's looking backwards.
Right.
And every investment you ever make is going to say past performance is not indicative of future results.
I agree with that. That actually brings me to a great next point. So we're actually in a situation right now. So if you were to take the situation we're in right now, and part of our portfolio, or a big part of it, is with a big institution like Stifel, the question becomes, okay, how do we now pivot? How do we now recover based on what we now know is available by way of your product? Do I call the institution up that I have a huge part of my portfolio in and say, hey, Stifel, are you using, measured risk portfolios product? And if not, can you get it? Or what does the average folks like us do when now we know that this exists, your product? We're stuck in, where we're at. How do we pivot? How do we make it better?
Yeah, so it's a great question, and it's a two-part answer. In the first instance, you would contact them and say, hey, do you guys have this product and or can you get it? And it's a question of how significant is your advisor within the context of that entity. If they're a tiny advisor in a very big firm, they're probably going to be told, something not wonderful. If on the other hand, they're a major producer, they would reach out to us and we would then do the appropriate.
10 years ago?
Like 10 years ago, he was on the cover of Barron's.
Yeah. So I would like to think he's not a little guy.
Okay, fair enough. Then he would reach out to their compliance department, that would then reach out to us, and we'd reach out to them, and we would do what's called they do a due diligence package, and we sign an agreement. That's the one way. If on the other hand, it's somebody who's not, who hasn't been on the cover of Barron's and who isn't an influence, then then the choice is that you have to decide whether or not you want to stay in that relationship with those limited choices that he has available to you. It's just that simple. It's what we're doing isn't not doable by others, but nobody else, hardly anybody else is doing it. That's the whole thing. And it's like, come on, people, this is a so much better way of doing it, because our portfolio is based on math, and math we can all understand. Meaning, when the market goes down 10%, you need to go up 11% to get back to break even, which is a pretty common return metric. When the market drops 20%, however, things are starting to get a little more interesting. You have to go up 25. So it's not this linear relationship. So when the market drops 50%, it's got to go up 100%. So now you're talking about a sequence of events that is, much lower probability of having a positive outcome. And especially when you get into those, 20+% down, drawdowns, the likelihood of a very quick recovery is quite slim. And, there's enough macroeconomic factors out there today to make us go, well, maybe we have to go down another 20 before we go up 20. Right. That doesn't feel so good. Yeah. So especially when, maybe we have to go down 50 before we go up 20, that feels even worse. Right. But the worst part of that conversation is the not knowing. It's the unknown. How bad is it going to get? On the other hand, maybe this is it. Maybe tomorrow the Fed says, you know what, we think we're done with interest rates or whatever they say, and the market takes off, and you don't want to not be in there to capture that recovery. So, what our portfolio allows is to have a finite, knowable drawdown while having an unlimited, upside capture. And we just think that metric of, unlimited upside with limited downside, we just think is fantastic. I mean, it's
let me address the pivot.
So Justin had to leave for just a split second, but I'm still here. So I hope that didn't kind of throw you off, but he has to address something right away. But I'm
no problem. Sorry. Well, let me address the pivot, because one of the things that's interesting about this is if you're in if you're suffered a 10 or a 15 or 20% loss, it's during 2022, and we're sitting here kind of waffling about whether or not the market's going to stage a recovery or just roll over and have the second half of the 20 or 30% additional loss, which we don't know until it gets in the record books. What we offer at any given moment, literally any moment in time, is the ability to set a new floor versus what you've got now. Because what a traditional portfolio has now is losses that they've already suffered and more unknown losses that could occur.
Correct.
Now, they can be mitigated by how much cash or other types of investments are put into the portfolio. So you can build a portfolio that might have only a projected drawdown of 6% over a period of rough time, but it's a projected loss that could, in theory, spiral into 16% loss or some number bigger than you anticipated if certain things don't behave a certain way. What we're able to do in a much more structured way is build a portfolio using things that are very transparent, so you can see what the moving parts are, to build you a new level of downside protection. And it's done through defining how much risk we're going to put in the portfolio. Now, amount of risk that you put in the portfolio is directly related to how much participation you're going to get on recovery. So if you have only a small amount of risk today and the market takes off like a shot, you're only going to get a small amount of that participation. But the good news is it only takes about 10 to 15% of your portfolio at risk to have a pretty good shot at having a very strong participation rate in the market's movement. So you don't have to put 30 or 40 or 50% of your portfolio at risk in order to get that type of movement. And that's what we've been able to do now for, upwards of 15 years. We started the strategy back early in 2006. And we've been doing this for a long time now. So we've got a lot of market experience, a lot of history that we can share with people and document different time periods and be able to show how this thing works. And what's nice about it is that we don't know what's going to happen. No one knows, but we do know what the worst case scenario is before you actually take your first step.
That's really great. Thank you for sharing that. And you've educated me on something that I never know that I want. I do want to kind of segue into, when Justin and I, as law partners and partners in life, were married, we created ReLAWtionship because, what the things that I'm interested in looking to, the resources that I look into to kind of learn about the things that I'm interested, I was seeing that there was a gap, a void with hearing about the do's and don'ts and the real nitty gritty stuff about partnerships and people going into business. So I said to Justin, I really want to have a real authentic dialogue with people out there that are either partners in life, partners in business, or both like Justin and I are. And, so because I find it fascinating because everybody talks about either the end product or the end service of what it is that they're passionate about and things that they do. But for your relationship and the reasons why you guys decided to partner up and do this, nobody gets to hear about that. And that's the stuff I always like the backstory. I always like to know, all the ins and outs. And so I want to segue into ask you guys the obvious questions, or not the obvious, or not so obvious questions about what are some of the pitfalls that you guys have run into as a successful partnership. Now, you said that you've been doing this for 15 years now. What did you guys deal with any struggles in the beginning of a partnership, or was it something that it just gelled right away, and from that point forward you haven't looked back and everything has been smooth sailing? I want the audience to really hear, because there are a lot of people that want to go into business together, right? You always hear, don't go into business with your friends, don't go into business with your family members. I want to hear from two successful partners that offer a really, really great product and service. What you guys have experienced in your partnership from the very beginning to what it is that you experience now as partners.
Let me just start off by saying that, you use the terms ins and outs, but when it comes to Larry and I, there's been no ins and outs. Just this, we have our respective spouses for, to cover that. But in terms of
business partnership.
Exactly. But we do refer to each other sometimes as like my daytime partner is Larry, and sometimes when I'm in a conversation I say, and my partner Larry, and people look at me, well, hang on, so well, anyway, there's my wife type of thing. So we've been able to separate those two quite well. It's interesting, I used to be housed with a big insurance company, and I got tired of paying the couple $100 a month rent, and I met Larry at a company event. He was affiliated with the same company, and he had his own office, and I was all excited about, maybe I can do an office share arrangement with you. And he's like, yeah, that'd be cool. And, we teamed up. We kind of tiptoed into the whole thing. It wasn't like a premeditated, let's partner up. And, I think I shook up Larry's life just a little bit. I assume he's going to give that nod of approval of hell yeah. His calendar used to be, da-da-da-da-da. And then, Wednesdays and Fridays, there'd be some time available to actually do something work related with him. But that changed quite quickly. I came over, brought a couple of people with me, and shook things up a little bit.
5 people, Bernard.
You even remembers 5 people. I don't remember the number, but anyway. And, I think what's made our partnership unique, and it was about a year later where Larry said, look, consider doing this office share thing after he presented me with my first bill, which was off by about a factor of enormous. And the spreadsheet he had built had a negative where there should have been a positive, which caused me to owe him more money than I earned that whole year, which we resolved amicably. Obviously.
I was just testing Bernard to see how he was doing on that.
We at some point Larry said, why don't we just join all of our stuff together, and we'll set it up this way. And we drew up a partnership agreement. But the one thing I think that's been unique in our relationship is, number one, is we don't do anything major unless both of us agree. So we both hold veto power over making, really big decisions. Small decisions, go make them. Some are going to be right, some are going to be wrong. And there's no holding one. There's no looking back and saying you decided to do that. There's no blame game that goes on here. We have each other's backs. If I do something and it didn't work out perfectly, I know Larry's got my back. If he does something, I've got his back, because we know that our intent here isn't to try and beat out the other guy. Our intent is to try and build something solid. The client has to come first. So everything we do is client focused. If something happens and we have to do something there's nothing to discuss here. There've been times where I've had to take extended breaks from work, and Larry just says, I've got the con, and I've got the control, whatever it might be. And, same goes the other way. If you need to, okay, just go get it done. When you go on vacation, I'm not going to try call you. Just go be away from us. Go have a good time. You call me. I don't want to call you. That type of thing.
Right.
So those have been some of my experiences. And I have to say, I've here we are. I think it was 17 years later, Larry?
Yeah, right.
Give or take a week or two. And we've actually almost killed each other. I think it's been 4 or 5 times, but one would think it's been because of anger, but it's the exact opposite. We've had these laughing fits that just break down into these hysterical bouts of laughter where we're both almost choking, and I've had to leave the room on more than one occasion. I mean, it's just...
But I love that you're saying this, because that's exactly it. I kind of feel like most people in the business world feel like it has to always be about business. And I love what you just said, because one of the keys to our success, both in our partnership and business with our entire law firm and our marriage, is laughter. Is that we have a great sense of humor, and we know that it isn't always about business, because it can't always be about business, because we're human, right?
I'm actually,
Right.
She
are very funny,
she just talks more than I do. It's great. I said I'm like the Fred Norris on like this show. I may get like a word in, on the once in a while.
There you go. Perfect. Yeah. Exactly.
I know my role. It's also part of being the partner. I know my role. Yeah.
Well, I think that in a similar way, Bernard and I are not dissimilar to our strategy, because I'm very systems oriented. I'm an engineering kind of a thinker, and Bernard is a ready, fire, aim kind of a guy. And without him, there wouldn't be nearly as much activity and energy and success, frankly. And he understands what I can do, and I understand what he can do, and he needs to do what he does. I need to do what I do. And I think in that respect, having a partnership that has dissimilar skill sets is actually helpful, because you're not stepping on each other's toes on what you want to do.
And ego doesn't get that way, right? If you both recognize each other, if your strengths and weaknesses are completely opposite, which is in our situation, the natural emotion that might come from ego doesn't come out, because everybody's staying in their lane, because we recognize what each strengths and weaknesses are. But what's not clear, though, and I want to go back to what Bernard had said before, was we kind of figure out each of us get to make the big decisions together, and little stuff we don't have to really clear with each other. But that's not a clear type of a situation. It's not like you set out, you have a partnership and you are able to think of every possible scenario under the sun as to what a big decision is. So when you don't have an established list, because that would be an impossibility, what are big decisions? How do you guys go about determining whether something's a big decision or not? Because I could totally see in any situation where somebody says, well, in my mind, this isn't a big decision, so I'm just going to pull the pull the trigger on this. And the other person's like, what are you talking about? This was a huge decision that you should have consulted me on. So how do you deal with situations like that?
I mean, but I'm going to take that on, because I remember the very first time Larry laid out, a rather what I considered princely sum on a marketing thing. I was like, what? But again, in the back of my mind is this thought of, is Larry's intent to do us harm, or is his intent to further our goals?
Right.
And in terms of to do us harm doesn't even enter the thought process for me. Like, Larry's not going to take an action that he deliberately believes is going to do us harm. He's not intentionally so he's doing it with the best of intention. If it means we have to spend some astronomical amount on a marketing thing that I might otherwise have gone, whoa, I would have given him the time to talk to me in more detail about it. And then I would have gone, oh yeah, that makes sense. And so you have to kind of question if there's a fundamental trust between the two people, you can overcome those things, even when, in my mind, it's kind of like, well, wow, that was more than I thought was kind of within that little framework of small, but it happened and it worked. And I was like, great. Then so I come back around and go, let's do that again, type of thing.
Right. But I think what's important too is to understand that we don't know if it's going to work. So it's really important to focus on the decision and the information you had to make the decision rather than the outcome of the decision. And that's one of the things that Bernard and I think, because we're traders and we are dealing with investment management, not every trade works out. not every decision you make is a winner. So the important thing to focus on was the information available to us leading us to a decision that we made that was a good decision and not a bad outcome from a good decision. So that's really critical in your thinking when you're trying to figure out whether or not a decision made was good or bad. And one of my analogies is if you've been at a bar and you've been drinking too much and you have this choice of getting in your car and driving home or getting an Uber to take you home, clearly the Uber is the better decision.
Right.
Unless the Uber driver has been drinking and he puts you into an accident, right? Well, that's a bad outcome to a good decision. And conversely, if you'd gotten into the car yourself and managed to get home without having an accident, well, that's a good outcome to a very bad decision. And so understanding the difference is really helpful.
Fantastic.
I think that brings us back around to the intent of the fundamental decision. Was the intent to try and do us harm, or was the intent to do us good? Even though it was something that was, and there was no doubt in my mind. It was with a good intent. So we carry on, and I said,
and also importantly, I learned from Bernard. He vocalizes what his concerns were, and so now I have a better data point to understand that that number was too large for his comfort level, and that sets a point where I get it. I get to know, because to your point, we can't have a list of anything over 5,000 or whatever. Pick the number. That's just not a functional way to operate. But it doesn't mean I can't ignore his response.
Right.
I have to be sensitive. But if you're the first time in a partnership sharing that information, you can't expect the partner to already know this. They're just getting to know the information, and so you have to allow. If you're on the receiving end of something that's disappointing you, you have to let your partner know, and you have to be aware that they didn't know, and so you can't hold them responsible.
I always tell everybody, communicate.
And that's a good segue into the final question here, because while I love my partner and my wife, if this podcast potentially goes till 10 o'clock tonight. So as I'm looking at the clock, and we all have things going on, my question is, if you had to give anybody any advice that's getting into a partnership, what would it be and why?
Or make it simple. How about what not to do, or what is your biggest lesson of what not to do in a partnership?
Or just answer her question. That's fine.
You want to take us one first, or you want me to go?
Do we start your
gosh. I think you can't rely on your partner to make sort of a bigger contribution. You have to be thinking about this, that, if you're in a 50-50 partnership, you need to really put in a little more than 50%. If that's the intent, then, and you do it in a genuine way, hopefully that brings out of your partner the same type of willingness to work hard and contribute. And if those are the two pieces, I think that's gonna lead to a successful interaction. And ultimately, as Bernard always says, and we say here at the firm, it's in our case, it's the mission, which is the client first. And if we're all focusing on that, and you have the same target, then I think you're going to have a good outcome.
I mean, I want to add something else there, which is focus on your core excellences. There's certain things that Larry does, and he's just so ridiculously good at, that for me to even try to take the time and effort to learn that or to do that, it's just silly, because it's just things that literally make my stomach go gurgle, gurgle, gurgle. Like, I don't like to do those things. And there's things that make Larry's stomach go gurgle, 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 which I happen to enjoy doing. There's no reason for him to even try and gain any level of competence in that, other than to say, hey, Bernard, take care of this. Or for me to say, hey, Larry, take care of that, or whatever it might be. So, and I think that to recognize your weaknesses is critical, actually, to a successful partnership, and making sure that if your weaknesses are complemented by your partner's strengths, well, then, 1 + 1 is 3. Carry on.
Right. And that goes right down to the staff, too. I make it very clear to our staff what I will not do. And if you ask me to do it, I won't do it, and it'll be a bad outcome. So don't ask me to do this. So that's part of being really clear and, back to communicating.
That's a great way to look at it, because that's how we hire now. We hire not based on position. We hire based on people's strengths, because people are happy when they're doing something that they're good at, or something that, they either they're good at or, they love to do. So we just basically hire and say, okay, what are you really good at and what do you enjoy doing? And we'll find a position for you, rather than.
Yeah, that's perfect.
Right?
Exactly.
Yeah, I agree. Yeah.
Works very well. And where can our listeners find you guys? I want to give you a moment to tell everybody where they could find and measured risk invest portfolios and how to get in touch with you guys. measuredriskportfolios.com.
Okay.
And our general email would be info at MRP, as in Measured Risk Portfolios. So MRP Folios, FOLIOS.com. Or it's a lot easier just to go to the Measured Risk Portfolios website and click on the Contact Us. And find us that way. Fantastic. Larry, Bernard, thank you so much for being on our first podcast today. It was actually really great. And thank you so much.
You bet. You guys.
Thank you.
I want you to look the list of institutions.
That's a wrap for this week's episode. Don't miss next week's episode for more relatable, real, and practical insights from ReLAWtionship, packed with even more candid conversations. So make sure to subscribe, tune in, and keep your wine glass full. And if you want to share your own experience or ask a question, follow us on social media and feel free to reach out. Go to CernitzLaw.com, call 888-68-DAMAGE, or email us at cshanbron@CernitzLaw.com or jcernitz@CernitzLaw.com.